You're looking for a new dividend investment, and you want something that not only grows, but puts cash in your pocket at the same time. That's where dividend ETFs come in. But when it comes to choosing a dividend ETF, 90% of investors are focused on the wrong thing. Because choosing the right dividend ETF is about so much more than looking at the dividend yield or the monthly payout. In this video, we'll look at 6 different dividend ETFs you might consider investing in. We'll analyze the pros and cons of each one beyond just the dividend payout, so that you can make the best investment decision for your money. The first 2 ETFs are both dividend ETFs from Vanguard, but other than that, they're actually quite different from each other. One is ticker symbol VYM, the Vanguard High Dividend Yield ETF. Like any Vanguard ETF, VYM has a very low expense ratio. At just 0.06%, it means you'll pay just $6 for every $10,000 you invest in the ETF. And that's one of the most important factors of choosing any ETF, because you want more of your money going to work for you and not lining the pockets of some fund manager. VYM charges such a low fee because it's a passively managed index fund. There's no slick Wall Street fund manager pulling the strings and picking stocks for the ETF based on charts or his gut instincts. Instead, VYM tracks the FTSE High Dividend Yield Index, which means it holds all 533 stocks included in that dividend index. On one hand, this means that VYM is well diversified. It holds stocks from all different sectors of the stock market and won't be too reliant on any one sector or any one stock to provide the growth or the dividend income that this ETF provides. On the other hand, are there really 533 quality dividend stocks on the market? When we invest in a core ETF at the foundation of our portfolio, something like the S&P 500 index, we're getting 500 stocks as part of that ETF. And we know that not all of them are amazing investments on their own. But all we're trying to do is mimic the returns of the overall stock market with a low amount of effort. We do this because it's well proven that trying to outperform the broader market over the long run is a fool's errand. But when we invest in a dividend ETF, we're investing for a more specialized purpose. With a dividend ETF, we're typically looking at its dividend yield, which is how much dividend income we'll get on our money right away. Its dividend growth, how we can expect that dividend grow over time, and the overall return the ETF provides, because we want to make sure our investment dollars keep growing even as we receive those dividend payments. To achieve those goals, we don't need to hold all of the dividend stocks, do we? Over the last 5 years, VYM has returned about 60%. It pays dividends quarterly, and the current payout is about 96 cents per share, which is a dividend yield of 2.74%. Now, over the last 5 years, VYM has seen its dividend payments grow from $2.91 per share annually back in 2020 to $3.49 per share in 2024, a 19.93% increase in 5 years. But by holding 533 dividend stocks, it's almost guaranteed there are going to be flat out bad dividend stocks included in the ETF. Ones that will not only cut or eliminate their dividends, but also drag down the performance of the ETF in the process. And VYM doesn't do anything to weed out dividend stocks that might drag the ETF down. On the other hand, the other top dividend ETF from Vanguard, VIG, the Vanguard Dividend Appreciation ETF, is a little more particular about which dividend stocks it includes as part of the fund. To be included in VIG, stocks must be US large cap stocks that have increased their dividend payment for 10 years. And it excludes stocks that have an overly high dividend yield. At first, that might sound insane. Why would you not want to hold stocks that pay the highest dividends? But when you see a stock that has a really high dividend yield, that's usually a warning sign for a troubled company that has a stock price that isn't performing well. The falling stock price will cause the dividend yield to be higher, or it can't sustain the dividend they're currently paying out due to whatever trouble is causing the low stock price, and it will cut or eliminate the dividend to protect the health of the company. That's a long way of saying that VIG has a better methodology for choosing dividend stocks. giving you healthy dividend payers with a track record of paying you more in dividends each and every year. And it does all this for the same 0.06 expense ratio as you have on VYM. VIG holds 337 stocks as part of the fund from all different sectors of the stock market. And while VIG does share 4 of the same top 10 holdings as VYM, albeit in different proportions, only 1/3 of VYM's 533 holdings are also found in VIG. So they are very different dividend ETFs. And VIG has returned over 72% over the last 5 years. And it currently has a dividend of about 88 cents per share for a yield of 1.73%. And here's why you should look beyond dividend yield when looking for a dividend stock or a dividend ETF. VYM yields 2.74%. VIG yields 1.73. VYM is obviously better, right? Not so fast. Because VIG has grown its dividend from $2.30 per share in 2020 to $3.38 per share in 2024, a 46.96% increase in 5 years. So with VIG, your dividend payments are growing more than twice as fast as with VYM. And it's outperformed it by over 12% in total return over the last 5 years as well. Another dividend ETF that compares closely to VIG and is arguably the most popular dividend ETF on the market today is SCHD, the Schwab US Dividend Equity ETF. SCHD has a history of being one of the best performing dividend ETFs on the market over its history. Like the Vanguard dividend ETFs, it has an extremely low 0.06% fee for holding it. What makes SCHD such a popular and proven high-quality dividend ETF is its criteria for the stocks it holds. SCHD requires the stocks it holds to meet a stringent criteria on having a track record of increasing dividend payments while having an above-average dividend yield in the process. To go along with that, it also screens for several financial health metrics to ensure it's only holding what they believe are the best of the best dividend growth stocks on the market. And SCHD is even more selective than VYM or VIG when it comes to selecting stocks. SCHD holds only 100 stocks as part of the ETF, where both VYM and VIG hold 3 to 5 times as many companies. If you want more detail on how SCHD picks its stocks and everything else about it, I have a deep dive video on SCHD that I made, which I'll leave linked in the description below. And over the last 5 years, SCHD has returned just over 72%. It has a current dividend payout of about 27 cents per share for a yield of 3.64%. So SCHD and VIG are pretty on par when it comes to total return. But when it comes to dividend yield, SCHD provides you with much more current income than either of the 2 Vanguard ETFs. When it comes to dividend growth, SCHD has seen its dividend grow from 68 cents per share in 2020 to 99 cents per share in 2024. That's a 45.6% increase in just 5 years. SCHD also recently underwent a 3-for-1 stock split at the end of 2024, which is why the absolute dividend numbers may appear much smaller than other ETFs in this video. And the next dividend ETF we're going to take a look at is one that has outperformed both SCHD and VYM over the last 5 years. This ETF has returned over 79% over that time period and has a dividend yield of 2.26%. It's ticker DGRO, the iShares Core Dividend Growth ETF. DGRO also has a selective screening process for the stocks it holds. To be included in the ETF, companies must have met the following criteria: 5 consecutive years of dividend growth, while paying out less than 75% of earnings as a dividend, and dividend yields not in the top 10% of the stocks it screens. Again, we can see that the focus is on quality dividend-paying stocks that will continue to raise their dividend each and every year. My favorite aspect of the selection criteria is the requirement that the company pay out less than 75% of its earnings as a dividend. This ensures that not only the dividend will be sustainable, but there will be room for the company to continue increasing the dividend in the future. Not just a company with an 8% dividend yield that's paying out more than they earn each quarter in order to sustain the dividend. DGRO holds 406 dividend stocks as part of the ETF. And its last dividend payment was for about 38 cents per share for a dividend yield of 2.26%. In 2020, it paid out $1.03 in annual dividends and saw that rise to $1.39 in 2024, a 34.95% increase over those 5 years. And while all of the 3 previous ETFs on this list had the same expense ratio of 0.06%, DGRO's does come in a touch higher at 0.08%. And really, that difference should be a non-factor in your decision over which of these ETFs to consider, in my opinion. With that difference, you'll only be paying $2 more per year for every $10,000 you have invested. When comparing these dividend ETFs, it's much more important to go with whichever one you feel has the best methods for choosing its stocks. Our next 2 dividend ETFs are completely different to the others in this video, and could be very interesting candidates for your portfolio for that reason alone. Each of the dividend ETFs we've discussed so far has one thing in common. They're extremely heavily invested in the largest US companies on the stock market, which is totally fine, but often we want to diversify our portfolio when we're adding new ETFs to our holdings. And most of us already have sizable holdings in stocks that are included in the S&P 500. Ticker REGL, the ProShares Midcap 400 Dividend Aristocrats ETF, is an option to consider if you want to turn away from those same companies that every other ETF focuses on. REGL focuses on holding the absolute best dividend-paying mid-sized stocks. Now, to be a mid-cap stock, a company has to have a market value between $2 and $10 billion. So these are still rather large established companies, just not to the size of most of the companies in S&P 500. Many of which have market caps in the hundreds of billions of dollars. To be included in the REGL ETF, a stock has to be part of the S&P 400 Midcap Index, and it has to have increased its dividend for 15 consecutive years at a minimum. And it's also the smallest ETF we've looked at so far when it comes to the number of stocks it holds too, coming in with just 48 holdings. REGL has returned 40% over the last 5 years, and it currently has a dividend yield of 2.28%. It paid out $1.51 per share in dividends in 2020 and grew that to $1.84 per share in 2024, an increase of 21.85%. It has an expense ratio of 0.4%, which is a little high, but still what I deem acceptable if the ETF really interests you. Another dividend ETF that you can use to diversify your portfolio in the process is one I guarantee shares 0 holdings with any of the other ETFs mentioned in this video so far. It's ticker SCHY, the Schwab International Dividend Equity ETF. You can think of SCHY as a world-traveling version of SCHD. It uses all the same stock screening criteria we love about SCHD, the 10 years of stock growth, financial strength, and stability metrics. It just applies that criteria to companies based outside of the United States. It's still a relatively new ETF, only making its debut towards the end of 2021, but it sports a 4.62% dividend yield and only has an expense ratio of 0.14%. SCHY has 104 holdings, and even though many international stocks have abnormal dividend payment schedules, at least compared to what we're used to here in the US, SCHY pays its dividends quarterly just as you typically expect. It's also grown its dividend nicely over its short history as well, from about 82 cents per share in its first full year on the market in 2022 to $1.07 per share in 2024, an over 30% increase in just 3 years. And I know there's a lot of debate about the need for international stocks in your portfolio because they've underperformed the US in recent history. But I'm of the opinion that none of us know where performance is going to come from in the future. So if you're looking for some international flair in your portfolio and want to collect some big dividends in the process, I think SCHY is absolutely worth a look. And once you've got the dividend ETF you've been looking for, your next step might be to look to add a boost of extra growth to your portfolio's performance. Click on the video on the screen right now for 6 growth ETFs that have been smashing the performance of the S&P 500. Thanks for watching this video, and I'll see you in the next one.